Yo guys, welcome back to Stock Talk Insider. Today we will be talking about the Honest Company, probably one of the most talked about stocks on this channel, as I say almost every video about Honest. But I just want to make a full, talked about video about Honest. A little extra after the earnings. I already did one, but just an extra, and also just giving some extra thoughts of my own onto this video and onto this stock, and just going forward after that. So before we give my own thoughts, my own projections and all of that sort of stuff, I want to talk about the details of this company. And to start with, that is, this company is really heading after their latest earnings, where they are heading, of course. And if you have been following the story, you know Honest is not just another consumer brand. It's a company going through a full business model transformation at this point. And under CEO Colin Vernon, and the decisions being made right now will determine the trajectory for the next 5 to 10 years. But for now, we'll have to bleed a little bit more on this stock for the coming year. And actually, now you really can't really know where the stock is going unless you stay in for a year, and in 1 year we'll probably have a bigger picture of what will happen and what is happening. But that will be more clear going further into the video. But for now, my advice already is keep it at a very small position. For me, it's actually a very, 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 very small position. It's not even 0.5%, I think, of the portfolio. It's like 0.3% or 0.4% of my whole portfolio. So this is a very, very, very small position for me. But then again, I want to build out. But as you know, if you look at the Honest Company, you look at news, there's not that much of news. You have a lot of articles posted around the same time, but it's all about the same, actually. Why shares are tanking, why analysts cut their expectations and all of those things, and the overall story of the earnings and the stock itself, which we already know. So you don't have a lot of news coming out from the board, from the company, from the CEO, or any other source around or about the company. So you can't really decide a lot on behalf of the things you already know. So going forward, my position is 140 shares. I think that's already big enough for now. If you see, my total portfolio is around 75 to 80k sometimes for this period. And having a position in a very speculative stock at this point of between $350 and $400, in my opinion, is very nice position to start. That's where I will start. And this is a speculative stock, of course. You have to keep that in mind. There's not a lot of news coming out. The revenue is indeed declining, but there are reasons because of that. But there are a lot of scenarios that can play out, and that is the one main thing. So on the front of the company, revenue is declining, and that's because they want to improve margins, so take low margin products off the shelf. So you have less of a shelf space available of Honest products in stores. That brings revenue down, but margins up probably, and net income keeps up. But of course, they already did a lot of quarters with actually net revenue, which is nice. And they are, ticking around that 40% margin. Now, last quarter, it was down and it was under 40%, but the quarter before that, it was above 40%. So now the question is, where is this company going? Well, actually, nobody really knows. They are just cleaning ship, actually. And then you have two scenarios after the ship has been cleaned. So the company in this matter, so after the company has been cleaned of all of the low margin products and it's been optimized, then you have two scenarios. So they can build up from there with a clean ship going forward and make bigger marketing moves, bigger products enhancements, and go further into actual revenue growth, take the 100 million a quarter and above that, and that with the improved margins. The other scenario is that they are cleaning ship to make a very nice and attractive company to sell. So, well, another type of company can buy them out or something like that, and with a nice balance sheet, which they have. A balance sheet is something you can't use against others because that's very, very good and nothing really wrong in there. But yeah, the revenue, the margins, and all of those things really scared a lot of people. So going forward in, well, the business overview, Honest operates in baby care, skincare, household, and wellness. Their brand identity is built around clean ingredients, sustainability, non-toxic formulations, trust, and transparency. So its retail presence includes Target, Walmart, Amazon, Ulta, Whole Foods. So this is not a small DTC brand anymore. This is a real shelf placement, real retail partnerships, and real consumer brand value. But of course, with declining revenue in his whole as the front problem for a lot of investors. But yeah, you have to take into account this can be something going forward for another year. But again, revenue going down, and the shelf, the shelves place that they have in a store, which is shrinking. That's also something that scared a lot of investors big time. So yeah, that's the thing that they are working on. So shelf space will be a little less than normally. They have less products, so they have better overall margins. Then revenue growth will take a hit on that. And after that, they can build up again and make revenue growth. And yeah, as you see now, you have some declining on the trailing 12 and especially on the quarterly, of course. But yeah, this will maybe decline even more or stay flat for the coming 3 to 4 quarters. After that, there's another chance to talk about it, maybe going back up. Or this can happen sooner, of course, but in how I watched and heard the earnings call, I believe this can be something going further into in another year. So, starting from 27 then, we'll probably have a very clean ship, very optimized business, and with 2 scenarios possible, going forward to bigger revenue growth, which enhances more investors to invest in the company. And the other scenario is, well, sell the business, and then again, you can get a higher cut than you have now for the Honest company, and you still make some gains. And you get to sell it at a premium maybe. So, going forward, the leadership shift is something to talk about. Carla Vernon became CEO in January 2023. She previously held leadership positions at Amazon and General Mills, where she led multi-billion-dollar product lines. Her focus has been consistent: fix the foundation first, then rebuild the growth engine, then scale responsibly. And you can really see that in the way they operate and she operates. This leadership philosophy matters, well, because it explains everything we're seeing in the numbers, and it's actually very logical to say as we see it. In Q3 2025, this were the numbers and the earnings. Revenue came in with $93 million, down 6.7% year over year, and I believe this was actually kind of flat. Well, this was flat kind of quarter over quarter. So yes, revenue is down, but there's where it gets important. Gross margins were down 140 basis points, so it stood around 37.3%. Net income was positive, up 3.6% year over year. Profit is actually improving even while revenue decreases, so that's actually a very nice catalyst. And yeah, still healthy, but under pressure from low margin products categories. Adjusted EBITDA was 4 million, also again something else that scared a lot of people, but this is now the 8th consecutive quarter of positive adjusted EBITDA, but again it was down year over year. But as long as that stays consecutive and positive, that's nice, together with the net income and, well, margins that stay kind of, well, flat or you can say stable. But again, yeah, we'll have to see. The most important line for, well, Honest, and probably also the most important catalysts to use scenario 2 is cash plus cash equivalents going to 71 million, which is up 18 million quarter over quarter. Actually, for the two scenarios, so if you want to sell it, it's very, very nice to have some good cash to work with and a clean ship in, well, products to build further on. But eventually, if you want to go further on your own, that's actually just the same. So having cash and a lot of cash is very important, but as you know, the company is like 350 million in market cap. So having 71 million and growing 18 million year over year right now, that's big time. So the company is strengthening its balance sheet while shrinking or eliminating unprofitable revenue. This is strategic, not accidental. But I want to mention one thing about Honest. Well, the products they sell aren't at this point very, well, it's not, it's like boring business. I'm saying it like that. It's kind of a boring business, but in the way they are operating right now, that is not that boring, because there are not that much companies. We really have to look very good that are, well, valued like this and having that much cash, having net income, a gross margin against 40%, and they are not even growing revenue, so they are not even growing as a company really. So yeah, already having 40% of gross margins is very nice. And yeah, having revenue of almost $100 million a quarter and only having 250 million in market cap, that means that they are making more money than they have in market cap. So yeah, why revenue is declining on purpose, kinda. So during earnings, Honest announced a very big thing. So the transformation 2.0, powering Honest growth, that includes exiting low margin and non-strategic product categories, exiting their Canada retail footprint, exiting Honest.com in-house fulfillment, reducing SKU complexity, restructuring SG&A and improving supply chain efficiency. So already, well, 1, 2, 3 things that they are getting out of. So the Honest.com in-house fulfillment, the Canada retail footprint, and also just in its whole the low margin and non-strategic product categories in stores. So going forward, the products and channels being exited account for 22% of current revenue. So of 100% in revenue, 22% has been cut. So that's why you see revenue going down, because there's not revenue coming out of that. So you will see a decline, and maybe over coming years you see an extra uptrend. Then this is why revenue is declining now, but it sets the stage for the following things: higher margin, stronger profitability, cleaner inventory, simple logistics, better long-term growth runway. But even with 22% of current revenue going down, they are still doing so much money for the type of market cap they are. So this is exactly what e.l.f. Beauty did from 2019 to 2021 before becoming a 20x stock. Gross margin and profitability path is that Honest long-term margin target remains 40%, but short-term margin pressure is normal when weak SKUs are removed, distribution channels are reorganized, supply chain is optimized, and of course, this is temporary margin compression for long-term margin expansions. Net income is already positive and cash position is growing, which is the real foundation for the future growth. Some clarification about inside selling is there has been insider selling, but it has been scheduled and, well, automatic following the 10b5 1 plans. It's not exit-based selling, no strategic insiders have reduced meaningful positions. No institutional red flags are also present. Well, most selling has been stock-based compensation, tax management, normal liquidity events after vesting, and, well, not conviction-based selling. This is not a negative signal overall. If the CEO or board were bailing, they would not be cutting revenue today to build a long-run margin structure. That move only makes sense if you're planning to stay and scale. So what's the long-term potential in my opinion? Scenario 1, independent growth. Honest uses transformation 2.0 to increase margins, increase free cash flow, return to mid to high single-digit revenue growth in 26 or 27. This is the e.l.f. playbook actually, and, well, improve foundation, scale through beauty. Then the acquisition is also something we've talked about already in this video. A clean brand with positive net income, positive EBITDA, strong cash position, simplified product portfolio becomes a very attractive buyout target for, well, doesn't have to be these ones, but it are things that can. So Unilever, P&G, Johnson & Johnson, L'Oreal, or private equity brand aggregators. You cannot sell a messy company. You can absolutely sell a clean, profitable, focused one. And Honest is positioning for optionality. My position and risk management view again is that I personally see that Honest has a small long-term asymmetric upside position, but not a portfolio core holding, of course, not something to overweigh in the short term, because revenue could remain weak for the next 12 months or even more, and margins will need time to rebuild. Consumer environment is still mixed, but the foundation is improving, the direction is correct, the brand remains strong, cash positioning is strengthening, and optionality of a future buyout is real. So this is a slow build story, not a momentum trade. And the final statement to end this video is that whatever happens, stay clear on this following thing. Honest is being positioned to win regardless of which path, and whether that means staying independent and scaling profitability again, or becoming an acquisition target. The company is doing the hard work now while the market is not paying any attention and selling the thing off. And that's usually where the real opportunities begin, or even are already starting. So, thanks for watching, and I'll see you guys later. Bye.